And I'm not here to criticize you because I was there in '05, my very first passive investment deal. It was a disaster. I made every mistake possible. I even actually invested in the first deal. I didn't even know it was a syndication. I invested in this first deal with this gentleman that I call Maserati Mike. I gave him my money. I didn't know. Sounded like a great deal. Mobile home park, real estate, passive. Great. So I gave my money. I was getting checks for a couple of months. Maserati Mike comes back to me and goes, hey, I've got another deal. Okay, I invested in that deal as well. Well, 6 months later, checks stop and I'm getting pissed. Communication stops. And 18 months later, the money is gone. And I know a lot of people are going through this right now. And I had this like withdrawal. I was so pissed off at Maserati Mike. But, you know, when the dust settled and I really had time to reflect, I was pissed at him. He was a crook. He was a fraud. But I was more pissed off at myself because I had no right in taking my hard-earned money and putting it into a vehicle that I had no idea the risks. I had no idea how to underwrite a deal. I shouldn't have had any business investing in real estate. And I think that's where a lot of people fall today.
And so, long story short, of course, I got my oldest daughter at the age of 16, bought her first single family rental property with her Roth IRA, and mom helped her out a little bit. And then the other two at 14 and 16, they purchased their own, or I purchased them. I was their bank for them, but little shipping container tiny homes that they used as Airbnbs. And we know that every child is a little bit different. And so when it was time to get paid for their monthly payout, the kids have to bring me their spreadsheet and go over their nightly rates. And then they get, paid out 50% of that goes to mom for footing it all. And then 50% goes to them. And so my daughter comes to me and she goes, okay, mom, I need to get paid. And I said, well, where's your spreadsheet? Well, I don't know how to do a spreadsheet. And all of a sudden my 16-year-old goes, oh, listen, I'll do the spreadsheet for you, but it's going to cost you 5% of your proceeds. And so I've got two, these children in particular. One is a super introvert, reads for 3 hours a day in his bed. And the other one is very chatty Cathy. And they're just different, right? And so when we take part in things like what you and I are talking about, it drums up an amazing conversation around the dinner table. And it's just healthy conversation about teaching the children how to be wise with their money and have their money make babies while they sleep. And that's their seed money, and to duplicate the heck out of it.
You're listening to the Real Estate Runway podcast powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Erin, the Deal Dynamo.
Well, welcome to our podcast today. We have got an incredible guest, Mr. Gino Barbaro himself. Gino, so good to have you on this Zoom meeting today. Tell us a little bit about yourself and what you're up to these days.
Hi, Erin. Jake and I are actually in buy mode. I know a lot of people are out there saying deal volume is down, deal flow is down. I see a buying opportunity. And if you can find the right deals in this market and you have the capital, I think the next 12 months is going to be pretty interesting. Jake and I started back in 2011. I think very similar to what's going on in this part of the market cycle. There was less capital to be raised. The interest rates were around 6.5% where they are right now. GDP was terrible. Consumer sentiment was terrible. And oh, by the way, deals were landing on LoopNet, where Jake and I found our first deal. So I see the similarities between when we started back then and where we are right now. Cap rates were starting to decompress. They're actually starting to really go back and compress again when we started. But we were coming out of that '08 recession, and sort of feels like where we are right now, to be honest with you.
That is awesome. Gino, we have something in common. I got a lot of kids, and I heard you have a lot of kids. Tell me, I've got 5. How many have you got?
We've got 6 children. So age is 24 to going to be 10 years old. My youngest is going to be 10 years old this year. Wow.
Holy smokes. We even have more in common. My youngest is 8. My oldest is 24. So imagine that. It's wild to see you and Jake out there, both with kids. You're still making it happen. And you've got this super successful company. And not only are you buying apartment buildings, but let's just share with the guests what else you're doing. You've got something else that's going on behind the scenes with education and whatnot. So maybe you can share with the guests a little bit about that.
That's actually interesting. I've got a lot of things going on. When you mentioned that, we do have a program called Passive Investor Pro. It's about to launch in the next 24 hours, actually. I've been working on this for the last few months because I'm sort of sick and tired of hearing passive investors complain about general partners. I think everyone's got a little bit to blame, right? I mean, if you're a passive investor and you invested in a deal, well, did you know what you were doing? Or were you just out there looking for a deal and going, I want a deal? Well, did you do your homework? And I'm not here to criticize you because I was there in '05, my very first passive investment deal. It was a disaster. I made every mistake possible. I even actually invested in the first deal. I didn't even know it was a syndication. I invested in this first deal with this gentleman that I call Maserati Mike. I gave him my money. I didn't know. Sounded like a great deal. Mobile home park, real estate, passive. Great. So I gave my money. I was getting checks for a couple of months. Maserati Mike comes back to me and goes, hey, I've got another deal. Okay, I invested in that deal as well. Well, 6 months later, checks stop and I'm getting pissed. Communication stops. And 18 months later, the money is gone. And I know a lot of people are going through this right now. And I had this like withdrawal. I was so pissed off at Maserati Mike. But, when the dust settled and I really had time to reflect, I was pissed at him. He was a crook. He was a fraud. But I was more pissed off at myself because I had no right in taking my hard-earned money and putting it into a vehicle that I had no idea the risks. I had no idea how to underwrite a deal. I shouldn't have had any business investing in real estate. And I think that's where a lot of people fall today. They've got this extra money sitting aside. They've heard cash is trash. That's all you hear for the last couple of years. They get their itis. I need to put this money and find a deal. And then you have these general partners that just, hey, they've got a deal and know, like, and trust. It works really good until it doesn't. So there's fault at both sides. And I think the most important thing that I gleaned off that whole experience was the sponsor, the alignment of interests, and the deal. That's what we call our 3-step framework for passive investing. It's important because you as a limited partner, it's going to be passive for you. But if you don't look at those 3 steps to investing passively, the first one is the sponsor. I had a terrible sponsor. I didn't know how to vet the sponsor. The sponsor had no skin in the game. So when the deals went bad, he's like, peace out, right? There was no alignment of interest. That second part, he just wanted the fees. He just wanted to get his money up front. He didn't care how the deals ran. And I didn't understand real estate. I didn't know that my money would sit there in an illiquid asset for years to come. The alignment of interest weren't between myself and him were terrible. And the third one was the deal itself. Passive investors, the first thing they do is they go, hey, Erin, I need a deal. Anything. I need a deal that makes sense. Well, when you go from that perspective as a passive investor, you're looking at it backwards. You need a good sponsor, someone who's going to know what they're doing, someone who's got experience in the asset that you're going to invest in. Then that second part, the alignment, then we can talk about buy right, manage right, and finance right, the third pillar of this framework, which is the deal itself. And when I keep hearing LPs complain and their GPs are not communicating with them and they're getting really frustrated, I say to myself, we all have the responsibility. And the reason why, lastly, I want really this to flourish is because I want strong limited partners. Because if we have strong LPs, then guess what? The deals that are weak, the general partners that have crappy deals, they're not going to get funded. And those prices are going to drop. So people like Erin and Jake and Gino can come back in and actually start buying deals that make sense and deals that make money.
I love that. So the new program, if you're interested, it sounds like he's got something brewing to find out for limited partners how to better position yourself. So I love that. So we'll share at the end here how you can reach out to Jake and Gino and learn more about that. So tell me, with the temperature of the market right now, you just said that you're buying properties. Tell me a little bit about that. And are you concerned with what's going on with the market and what has really caused you to buy? Have you really found the diamond in the rough? I'd love to hear.
I'm always concerned about buying. I'm always afraid. I'm the glass half empty guy instead of the glass half full. And I think that's what's kept me safe over the last dozen years or so. I always say, Erin, I have life before Jake, and then I have life after Jake. It's true. Life before Jake was a disaster for me. I made so many mistakes. All the mistakes that the syndicators are making now in this part of the market cycle, I made them in the last market cycle. So I know the pain that they're going through. I know the short-term debt that's coming due. I know not buying right. I know obviously not managing right. I made all of those mistakes. And when I started with Jake, that framework really helped us out to buy, to manage, and to finance. And for us, we were just talking off air before we started recording in 2021 and 2022. You did the same thing we did. We pared down and started buying smaller deals. They were making more sense. There was more value to them. You could actually create value and make a ton of money off of a 20 unit. We just didn't see the 100 units plus making any sense. There's too much free money out there. Their cap rates were so low and there was so much rent growth that they were just being overbid. And, for us to be able to buy right on the front end makes a lot of sense to us. If we can't buy with any type of value add component, with the ability to raise values on these properties, why are we buying them? I mean, obviously you're always buying for the long term. But for us in 21 and 22, it was different. It was difficult. And when you're buying deals in the marketplace that are stabilized on bridge debt, there's something wrong with that. That there are storm clouds brewing, and we just didn't want to play in that market. So in 23, we saw the opportunity. We bought 3 big deals in 23. We've got another 2 assets under a contract right now. And I think for anybody out there right now looking for the opportunities, there's two big areas of opportunities. The first one is the LIHTC, the low-income housing tax credit area. It seems like a lot of these assets were built in the early 2000s, and they're starting to come off their contract. We bought one late December of last year. And the other one is those developers that are just coming to market with their assets. They've either been built or they're just finishing up and leasing up, and all of a sudden, they haven't hit their numbers. They have to exit because they've got another opportunity. We've got one of those assets under contract right now. And I think those are the really 2 big opportunities that we're seeing in the market right now.
That is fantastic. So tell me this much. You guys have been at it for so long. How many investors do you have that you are working with that are part of your tribe?
That's the great question, because we don't syndicate deals anymore. We sold our 3 syndications. So all the assets that we're buying currently, we're just self-funding. Me, Jake, and my partner, Mike. We had that opportunity because when we started small. We started with the idea that we want to keep it in-house. We wanted to focus on what we called PPU, profit per unit. That was our metric. And we're fortunate that we hit the market cycle right. We bought in 13 all the way to 15, 16, 17, 18. We were able to refinance out all those proceeds. And I was lucky that I stayed at my restaurant. So I had my day job paying for my lifestyle, and the real estate was just going back into the business. Whatever I made.
We got to pause. This is incredible. Listeners, do you hear what Gino is sharing? Gino started where he was syndicating, and he has been so smart and intelligent with his buying and how he's structured things. He's finally in this position where he's reaching, you probably already at it, financial freedom at a whole different level because of the smart. That is genius that you are now in that position. So if I understood correctly, because now you're self-funding, doing your own deals, now you can put a lot more attention to, you've got an education program, right?
Yep.
And how long have you had the education program for, Gino?
We launched in 2016, but we launched the platform, Jake and Gino, in 16, but we launched the educational courses and all in 2019. So it's been 5 years.
Okay, well, I've got a sweet spot for you because that's how Chad Sutton and his mom, that's how they came in. They met you, and there was that tie and connection. So thank you for pouring into them. That's awesome. So how many people since 2016, how many people have you had come through your program?
We've had number of students, not sure the number. I know the students have closed over 80,000 units. I know they've raised over $500 million. I know they've got over $5 billion in deal volume. So, and the last metric that I'm really proud of is over 125 have left their W-2 jobs. So that to me is like a signature of success. Exactly. And it's KPIs in any business. And that's what our BHAG is. Our big, hairy, audacious goal is I'd like to have 1,000 students leave their W-2s by the year 2030. And that to me is a sign of success. That to me is like you're reinvesting in the community. People are understanding the model. And unfortunately, in multifamily, it does take a few years to garner success. It does take a few years to go through these market cycles. And for me to be able to see people that had no experience whatsoever, or that had a small portfolio of 30 or 40 units, and now you turn around and you see they've got 400 units and they're just changing lives. It's really an amazing thing to see.
It's fantastic. Fascinating. It really is fascinating what you guys have done. Way to lead from the front for sure. Gino and I, as he was saying, we were talking offline, and in 2021, Quattro Capital had purchased, 17 apartment buildings. And while we were in purchasing, Gino and them were kind of sitting in the back. But guess what? Now the roles have reversed. They're on fire in purchasing, and Quattro Capital is we're in protect, preserve. We're still looking at deals, but sometimes, it's hard to make them churn in this market with the economy and the way the rates are and cap
Mhm.
rates and et cetera. But I will say, don't you feel like you have a little bit of an upper hand because you have your community and maybe they're sharing deals with you, or you've been in the industry for so long that brokers are bringing those unicorns to you? Or how are they? I guess maybe you can shed some light as to how are you getting your hands on these properties in this space?
That's a great question, Erin. What I would say to you, what Quattro Capital is doing is they are doing part of the business that's really important, but often overlooked. Everyone only focuses on deal flow. Deal flow is great, but what Quattro is probably doing is they're probably still communicating and gathering new investors. They're working on systems. They're working on processes. They're networking with this podcast right now. So just because they're not doing deals doesn't mean that they're not doing the important work. That's what I think people tend to forget about. All they are deal junkies. We have respectively 5 children and I have 6. Well, you just can't have kids and let them grow up by themselves. You need to tend to those children. I think that's what people tend to forget in multifamily. You buy a deal, you have to treat it like a child. You have to let that child grow and you have to be there to nurture that child. But for us, it's the brand identity. And I think that's so often overlooked. The deal we did in December, that broker had been wanting to do deals with us for years. The deal we did in July, that was a student who was wholesaling a deal to us, a 105 unit deal in Knoxville, amazing deal. And listen, we just did a couple land deals in 2022 with the broker Solange in Knoxville. You probably know her. She loves us. She bought us these 2 deals back 2 weeks ago. You have to be out there. You have to make yourself known. Do you have to have 1,000 units? No, but hey, having a podcast, writing a blog, going to meetups, sharing your experiences, reaching out and trying to make a little bit of noise in the market always helps with the deal flow. And I think working on your brand and to me, I don't think you have to be a complete thought leader, but I think if you're out there and you're sharing what you're doing and you're being open and honest, doing that first deal, walking through that first deal with the camera and just talking to your investors, letting your investors know exactly what you're doing, sharing that on social media and just asking anybody, hey, if you want to be part of this opportunity, just reach out. I love to talk to anybody. Just start spreading the message. Don't be afraid to share what you're doing, because Jake and I, the pizza guy and the drug rep, that's exactly how we started. We started with a 25 unit little property. And from there, started getting investors, started finding partners. And before you know it, we're writing a book and starting a podcast.
It's wild. It's wild to watch your progression.
It
Kudos to you.
is.
So with 6 kids, I'm just curious, are they getting in the game? Do they have any interest? Kind of tell me where you're at with that or what you're doing to kind of water that.
It's really interesting. I interviewed a gentleman named Ken Honda about 6 months ago. He wrote a book called Happy Money. And I think you should check it out. It's an amazing book. And Ken on the podcast challenged me. He says, you should write a book called Happy Money, Happy Family, Happy Properties. I said, Ken, I'll do one better for you. I'm going to write a book called Happy Money, Happy Family, Happy Legacy. And for me, the journey has been a really challenging one with me for as far as money goes. I didn't have a great relationship with money early on. I had that one job. I felt as I was in scarcity mode a lot of the time. So it's a really interesting thing to see how my older children are a little different with money than my younger children. My oldest child, actually, she went to become a missionary. So she went out for a couple of years and was a little bit averse to money. But I said, Gabriella, guess what? Missionaries, what do they need? They need to raise money for their ventures. There's no margin, there's no mission. So money, it can be amazing. You can either attract happy money or you can attract unhappy money. And for me, I've just tried to keep it open for my children. I've just really had to have an open and honest conversation with them. My second child, my son, he's my second child. He has 9 K1s. So he's invested in 8 of our deals right now, and it's his own money. Keep refining, putting the money in and understanding. And now we've got these 2 deals right now. He's got enough money for one deal. His second deal, he's saying, Dad, how can I get more money? Can you self-finance it for me? I'm not seller financing you, Mike. I'm not diluting myself. Can I get a personal line of credit at Wells Fargo? Go ahead, see if they'll give you money. It's amazing. It's amazing to see what a 21-year-old will actually think. Me at 21 years old, I had 0 K1s. I think I had 9 K1s when I was 45 years old. So he's 20 something years ahead of me. But just to have them be part of the conversation, don't be afraid to talk to your kids about money, and be careful what you say about money, because that will become their blueprint. And that's why I had an unhealthy relationship with money for all those years, because I had that conversation with my family and my parents. And that's why, to me, this book is so important, because it opens up the conversation about not just making money, but how to create that happy family through the use of happy money, and how to really create a legacy that's happy that you can leave to your kids and to your grandkids as well.
Love that you said that. Kudos to your son, 9K1s. Listen,
Dude,
I think that just to share a little bit of my background, it's like I grew up with parents that worked the 9 to 5 jobs. And I just remember at a young age thinking, gosh, aren't we supposed to live our lives on our own terms? Like, I want to be my own boss, right? And then
yeah,
I became a doctor, and then I moved into the multifamily space. And there's nothing I wanted more than for my kids to win from everything that I've learned. How dare someone to learn all of that and not want to pass it down to the kids,
yes.
right? And
Hmm.
so, long story short, of course, I got my oldest daughter at the age of 16, bought her first single family rental property with her Roth IRA, and mom helped her out a little bit. And then
Hmm.
the other two at 14 and 16, they purchased their own, or I purchased them. I was their bank for them, but little shipping container tiny homes that they used as Airbnbs. And we know that every child is a little bit different. And so when the kids, when
Yep.
it was time to get paid for their monthly payout, the kids have to bring me their spreadsheet and go over their nightly rates. And then they get, paid out 50% of that goes to mom for footing it all. And then 50% goes to them. And so my daughter comes to me and she goes, okay, mom, I need to get paid. And I said, well, where's your spreadsheet? Well, I don't know how to do a spreadsheet. And all of a sudden my 16-year-old goes, oh, listen, I'll do the spreadsheet for you, but it's going to cost you 5% of your proceeds. And so I've got two, these children in particular. One is a super introvert, reads for 3 hours a day in his bed, and the other one is very chatty Cathy, and they're just different, right?
Yes.
And
Yeah.
so when we take part in things like what you and I are talking about, it drums up an amazing conversation around the dinner table. And it's just healthy conversation about teaching the children how to be wise with their money and have their money make babies while they sleep. And that's their seed money, and to duplicate the heck out of it. And so you also hear about kids who are part of families like ours that don't want anything to do about it. They're just like, I hear it all day long. I don't want to be any part of it, right? And
Hmm.
so I also think it's amazing that, I've got 5 kids, and they, of course, I work in my office, and they're hearing constantly me on the phone with investors and how to talk to people and the right mindset, and then having our standard calls Monday, Wednesday, Friday with our team. And so they get to be a part of this. And my hope is that each of my children in due time want to be a part of this real estate. I don't know if there's any other better investment. I just feel like it is freedom at the finest for so many reasons. So I guess I'll flip it over to you and ask you, what are your favorite things about investing? Why do you think it's so powerful? What are your maybe top 3 things that you think is powerful about investing in multifamily or real estate in general?
I think for me, it's the long termism. It's also being a liquid. You're in crypto. Oh, you buy it at 10,000, it goes to 30,000. You sell, you're out. You think you did really well. Well, we've bought deals. I bought a deal back in 2016. It was a 156 unit deal at 45,000 a unit. That deal went to, let's say, 90,000 a unit in 2019. Most investors would have sold out. They would have doubled their money. We still own that asset. I mean, the asset's probably worth 170 a door. That's the power of real estate. I think if you can give yourself the time to be able to invest in it and to hold it long term, the power that comes from that, you have the tax benefits that are truly amazing. And I think the most important thing, honestly, is multifamily pays you a dividend. I don't want to invest in a stock buying at $30 and hoping it goes to 40. I want to buy a stock with a dividend yield. Well, we look at multifamily the same way. We want it to yield every month with the opportunity to be able to refinance out in a couple of years, to crystallize the equity, pull that equity out, tax advantaged, and put it into another asset.
Yeah, absolutely. I couldn't agree more. I think there's so many advantageous things about investing in multifamily, especially if we could help those that are working 9 to 5 jobs and telling
Mhm.
them ways to duplicate their money, save on taxes. There's so many tax benefits all around, creating freedom and making money, like I said earlier, while you sleep, right? It's
Yes.
incredibly powerful. So I think kudos to you for what you have created and the empire and the legacy that you're getting to leave behind for your children. All right, Gino. So I want to hear, what advice have you got for Quattro? I'm so impressed with where you have gone from start to where you are now. Listen, I'm going to brag for this gentleman because he probably won't. He seems like a humble kind of guy, but over 2,000 doors. And the three of the partners, they own them outright. There is no more syndications. There are no more limited partners left. Super humble gentleman. So my question for him was, what advice could you give to Quattro? Yes, we've been at it for 4.5 years. You've been at it a lot longer. What would you say to that, Gino?
Yeah, I could spend the next 30 minutes, Erin, but really, I would love for you guys to think of all of these strategies as different tools. Syndication's a great tool. Seller financing is a great tool. I think JVing, and once you're at that point where you can start buying smaller deals by yourselves, just as a JV group, start buying those, using your syndications and acquisitions and asset management fees and all that to start getting that and start getting a little bit more equity in those smaller deals. So think of it as a conveyor belt. You have this belt in front of you, imaginary. It's a 5-year belt. You start buying assets. The goal is you don't make money in real estate when you buy, you make money when you exit. That's what people don't really understand. It took me years to understand that. You make cash flow, but when you make the $3 million refi check, come talk to me about the $300,000 in cash flow. So ultimately, you're trying to matriculate that equity, pull that equity out and get into the next deal. That's why sometimes it takes 6-7 years, because you may have to go through a couple of years of owning deals. So most of our coaches, they started with syndication. They were like, this is great. Let me buy 100 units, 200 units, 500 units. They're scaling up. They're getting these fees because they don't have the capital. But as they start seeing, I can buy this 30 unit with maybe 1 or 2 other people. And if I'm making $300 profit per unit on this 30 unit, that's $9,000 a month in cash flow. That can fund my lifestyle. So I've got one conveyor belt with syndicated deals. I've got one conveyor belt with my JV deals. So they're 2 different strategies. And guess what? I've got Airbnbs. That may be another conveyor belt that I've got going on. I have 4 single family homes down here. So I look at that as a different conveyor belt. They're different strategies. One's for long-term preservation of my family. The syndications that I had, that was more for like, we're running out of capital. Let's create this. We have our investor base here. There's value in that company, that syndication company you guys have, because you have a brand there. You have investors, you have IP, you have the website. So that in and of itself should be looked at separately. And then when you're doing your own deals, that in and of itself is where your true wealth can be really created. Because if you own a couple hundred units, 300 or 400 units, just with you and a couple of other people, you are your own bosses right then and there. You can do whatever you want with those deals. You can hold those deals forever. You can sell them tomorrow. You can do whatever. Whereas the syndicated deals, you have a fiduciary responsibility to your investors. And sometimes you have to sell because it makes sense for them. We just sold our 3rd syndication back in February. We had to sell it because we hit our IRR. It was a great price point. And, we're going to have to wait 3 years before we get back to the price where we sold it at. So it's like selfish to be able to hold it just for us to generate fees and saying, hey, we're going to wait 3 more years. We're going to cash flow. It made sense for the investors for us to sell. Now, if it was a deal that Jake and I held, we probably would have refied that deal in a couple of years and maybe held it, but we didn't have that option with the syndication because we have to worry about them. So I think if you can use all 3, and then obviously the syndication will help you, because the small deals, they may be a pain in the neck to operate and to manage. But if you can bunch them in with the syndicated deals and use that economies of scale, you're like, wow. And that'll help your syndicated deals as well, because you've got these units here that the property management company needs to work on both. So you may be able to get some good deals for the entire portfolio.
Does it ever make sense for you to, when you sold the syndication, the last one in February, for you to then sell it, the investors go out, and for you guys to hold on to it? Or is it just too much of a high price for you guys to buy?
No, that's a good question. I think for us, if you're looking to, refi a syndicated deal, just put that in the PPM. Our very first syndication was in Louisville. We got out of Louisville because we didn't like the market with the whole Section 8 housing after COVID. But we bought it at a great price point. If we had refied the money, most of it would have gone to the LPs. We wouldn't have gotten any money. We didn't write the PPM properly. But I would definitely, like, if you're a 70-30 and let's say you're ready to refi the deal, how about returning 50-50? 50 goes to LPs and 50 GPs, and then you continue along at a 50-50 or whatever that looks like. I would absolutely do that. This 3rd deal we sold, it was another one where the asset was getting older. We weren't crazy about the market. So it's always a good time to sell when you're ready. I don't want to hold everything forever. It made sense for us to sell that asset. So think about your exit strategy going further into it. If you're buying a deal, it may make sense to say, hey, let's refinance this deal after 3 years, but let's get some money for the GP team, because all of a sudden you're putting extra debt on and you did all the work, and LPs should get their money back. But that's not fair for the GP team to not. And we made a mistake. We didn't write in the PPM that way. So
yeah. Hey, listen, you live and you learn, and you're better positioned now anyway. So
absolutely,
kudos to you.
absolutely, yeah, yeah,
I
absolutely.
love it. That was amazing. Amazing. Good.
Anytime,
Hopefully
anytime.
that value we'll share with the investors and perhaps some limited partners that are going to jump in the game and
Oh,
maybe
sure.
learn more about what they should do and shouldn't do before they.
Yeah, you guys have got a great team. I mean, just think about it going long term. I mean, like if you guys can start looking at that, because it took us several years to figure it out. It doesn't happen. It takes a market cycle. It takes some deals to matriculate, some deals to really come to fruition. And all of a sudden, should I hold on to them? But going forward, every deal you underwrite, just think of your exit strategy going forward, every deal.
I think it's the same. Even when we started, we said, look, let's do 2 syndications, 1 for Quattro, 2 syndications,
Yes.
1 for Quattro. And,
Yeah.
as you start to climb the ladder, you see from a different view. And then all of a sudden we're like, forget the syndications. This doesn't make sense anymore. It
Yes.
does. But here's the thing. We've got 750 plus investors, right? Many of them have done 3, 4.
That's a
There's a
lot.
couple of guys that have done 8 with us. And
Yes.
so we're like, you know what? I feel like we have done a really great job. Now it's time for us to create this fund and put a few different assets, put 2
Yes.
or 3
Like
assets
that.
in there and decrease
Yes.
the liability for our investors. And so when talking to them, that's what they're looking for because that trust has already been created, right?
Yes.
You first start out and it's got to be the know, like, and trust factor. Once you get that, then it allows you to graduate to another level. Right?
Yes.
Is there something that you would want to share with our listeners that you can leave them with? You're big on mindset. Maybe you can share something mindset wise with our listeners or any other thoughts you have.
I think we had the conversation about children, and we're really excited about sharing this with our kids. Just be careful not to introduce it too young. Don't be that Nazi about money, and you've got to save kids when you're 6 years old. You have to make it fun. You have to make it enjoyable. You can't make it punishable, and you cannot push it on them. They'll find their own. Once they start hearing it, my oldest daughter really didn't care about it. And all of a sudden she's got an Etsy account. She's invested in 3 deals. So it's just one of those things where they all grow into their own and you show it in a positive light and you have to be the steward. If you are going to teach them about money and tell them all about how amazing things are, and all of a sudden you open up your books and your life is a disaster, but you expect your kids to be great, it's not going to work that way. The kids can see through the nonsense. You have to be that steward. You have to have your ship in order. And listen, be authentic with them. Like you said, you want transparency and honesty. Well, be honest and open with your kids when you're having a struggle or you're not. It's hard to pay a bill or one of your deals is going south. It's really good to share that with the kids because they have to see that you make mistakes as well. And it's okay to say sorry to your kids. Learned that a few years ago. That sorry really goes a long way because then they can understand how relationships really should be. And all of a sudden they take responsibility for their actions as well.
Gino, that was like gold. That last minute and a half there is gold only because listen, at the end of the day, what do most adults want? They want better for their kids than we ever had, right? And so just teaching your children about that and saying I'm sorry is huge. It's a way to level set and it takes the I'm too cool away and it allows you to reach a deeper connection with your children when you say you're sorry. How do I know this? Hello, I've got 5, but yesterday I had to practice that very same thing and I had to ask for forgiveness. And forgiveness is actually such a beautiful thing because it creates a deeper bond between you and that child. So, man,
I agree.
A good point. Well, listen, how can our listeners get a hold of you? Gino, what have you got to share with them to get in contact?
Just go to jakeandgino.com. When you go to the website, you'll see all the different resources. We've got a couple of podcasts ourselves. We've written a few books. You'll see the testimonials. We've got blogs on there. So just go to jakeandgino.com.
And the coolest part about it is Gino is a bigwig. He won't admit it, but he makes himself available and he is such a cool human. So it's an honor to have you on here and great seeing you for sure.
Thanks, Erin. I appreciate it.
Take care. Have a good one.
Thank you.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.